So really quickly, I want to talk to y'all about the difference between a tax preparer versus a tax professional, because it's levels. A tax preparer is somebody that just punches keys. Okay, they don't really know the tax law like that. They're just able to look at your tax documents, input it into the software, and if you're self-employed, they really don't know what the hell's going on. They're really just going to be punching keys to try to get you some money, to get you a refund, because you're not really entitled to one. You're self-employed. You did not pay out any taxes during the year, so therefore you cannot get a refund on money that you didn't pay out in the first place. But that's a story for a different day. Anyway, a tax professional, however, is someone that knows the tax law, studies the tax law consistently. They more than likely have continuing education credits because we're constantly having to learn. They know the deductions that they can apply to you. They can tell you the different credits that you actually qualify for to get a refund or to reduce your tax liability. Now ask yourself, do you work with a tax preparer that's just punching keys, just punching anything in? Or do you work with a tax professional?
Hello, welcome back to my channel. I hope you guys are having a wonderful week. It is Mardi Gras season here in Louisiana, so I'll be taking a trip to New Orleans. I've never been to a Mardi Gras. I'm originally from Louisiana, so I'm super excited. And I just wanted to, before I go on this trip, I wanted to put as much content out there as I can. Not only that, but I have some catch up to do because I erased a few other pieces of content. But enough of my chit chat. Let's go ahead and jump straight to the video, and I'll be back with my commentary at the end.
When it comes to them taxes, my daddy said it's always better to owe than to pay. They're going to always take too much, and they're going to never give you back how much they owe you. So he said it's better to file exempt, put some money aside because you know you're going to owe, but don't never let them take your money because they will always take more and never give you enough back. He ain't been wrong yet.
If you prepared your taxes and you see that you actually owe money, do not file just yet. The IRS allows you to pay yourself instead of paying them. And yes, you can do this even after the year ends, and I'm going to show you how. You're going to open, if you don't already have one, a traditional IRA. I'm using Fidelity for this example. You see how it says tax deferred growth, right? I need that. Once you open it up, it's going to ask you to put money into it. It's going to ask you for what year. You will select 2024 so that whatever money you put into this is applied to 2024's taxes. This is not investment advice. TikTok, Instagram, do not play with me, okay? You have to pick whatever you want to actually invest in from this point. And then you would essentially go back into your tax preparation, whatever you're using, right? And then add in that amount that you've actually contributed. But listen to me, this is not a dollar for dollar impact. Taxes are complicated for absolutely no reason. They muddy the water so you cannot see. Based on whatever tax bracket you're actually in, so whatever your taxable income is, will tell you how much you actually save. So let's say in our example, this person makes $150,000 that's taxable. That puts them in the 24% tax bracket. The max that you could contribute for 2024 is $7,000 or $8,000 if you are above 50. So if you max it out and you're under 50, the most you could put in is $7,000. With the 24% tax bracket, you'll actually save $1,600. That's going to you instead of going to the IRS. Of course, when you put your money into the traditional IRA, there are steps to get it out. So understand that you're not going to just put the money in and then just take it back out. No.
They'll never know. So that's a great question. If you don't file your tax return, will the IRS ever catch you?
So I took a course in graduate school a few years back, and the entire function of this class was basically audit management. And it talked through the process of how the federal government and even some states actually goes about selecting who they plan to audit. And it is not as randomized as you may think. And they actually don't individually comb through every tax return. Like a person doesn't do that. It's quite automated. So what happens is a calculation system determines which social security numbers or tax ID numbers garner enough of a red flag based on earned income and based on potential tax revenue. And from there, they then apply some additional metrics and they decide if whether or not they're going to assign the case to an auditor. Yes, it is true there aren't enough auditors to manage all the cases that should be sort of gone after, but it's also true that they don't attempt to audit every person. The goal is not to look at every single return by an individual and determine if it's correct or not. A lot of that is done by a computer system, which is why the notices you receive are computerized. It matches whatever income was reported on your Social Security number with what you reported on your return, and it determines any discrepancies and it sends you a notice. If income was reported on your Social Security number and you don't file, oftentimes, that notice is also automated. Some states are better at this than the federal government because they're so behind paper-wise that they just don't have the system or the functionality to maintain it. But this is also worth knowing why this new rule is such a big deal, because they're trying to improve sort of how they manage this process. So for anyone who makes over $400,000, you're likely going to be assessed a non-filing notice and asked to complete your returns for any years you're missing, and they're likely going to have fees and interest for non-filing and such and such. Why this is important is because if it's successful and they're able to get a lot of tax revenue from this, they're going to lower the threshold. So it's going to go from $400,000 to $200,000 in income. And so the goal will be over time to encourage full compliance. But for people who are like, I'm not going to file, I'm never going to file, it's likely that you don't make enough money for it to warrant the effort it is going to take for the federal government to pursue you in audit. But as all things that go with the tax process, it's like, do it at your own risk. So, good luck.
It's come to my attention that not a lot of young people know how to do their own taxes, and they're getting ripped off by CPAs who charge them $500 for nothing. And I would know because I am a CPA myself, and we will rip you to shreds. We will take advantage of you. I know. Sorry. Anyway, do your taxes yourself. If you're young, you most likely only have a W-2. That is so easy. Play Go Fish with that W-2. There's boxes that are numbered. Box 1, 2, 3, 4. And then tax website. Look up a tax website. TurboTax. I use Free Tax USA because it's free. Not sponsored. Literally not sponsored, but they should pay me for saying this. Free Tax USA. Your federal is free. Your state, you are going to have to pay for, but it's like $20. $14 probably. $14.99. I don't know. Anyway, just type that in. Type in all your information. And then you're going to need your Social Security number. If you are over the age of 18 and you don't know your Social Security number by heart, get on that shit. You should know that. Don't carry around your Social Security card with you in your wallet. Because guess what? People will steal your information and then they'll clone you. Do your taxes yourself. W-2, boxes are labeled. The website will ask you, what is in this box? Do you know how to read? You might be a little bit dyslexic. I am too. Don't tell my boss that. Put the number that you see, what they're asking. Okay. The tax withheld is how much taxes that you've already paid in. The website's going to calculate if that was correct or not. Don't ask me. I do taxes for a living and I don't understand shit about taxes. Why do we have them? Where is it going? Where's my money going? I don't know. But just follow the directions, okay? You are going to know how much taxes you have already paid in, and the software or the website is going to tell you, oh, you paid in too much or you didn't pay in enough. And that is when you either get a refund or you got to pay a little bit extra. Listen, if you get 1099s, most of the time, you're not going to get tax withheld off of that. So you're most likely going to have to pay taxes. That's why when you're self-employed, you get 1099s, you should really leave some money off to the side. Put that in a high-yield savings account. But also, guess what? High-yield savings account, you have to pay tax on the interest on that. Ugh, that's crazy. And if you don't have a high-yield savings account, ask your bank for it. And do it, because instead of getting 0.00002%, you could be getting 2%. You could be getting 3%, 4%, depending on how much money you have. I got a lot of money in the bank because I'm a rich bitch. So I get 25% off my high-yield savings account. Just kidding. That's because I ripped off a lot of people. So that's why I'm giving you this advice. Do your own taxes this year. 2025, we are doing our own taxes. Okay? It's not that difficult. Don't make it more difficult. Don't get ripped off by a CPA. Don't get ripped off by me. You're welcome for the advice.
something really cool about owning a home. So my wife and I spend $2,800 a month for our mortgage. $1,850 goes towards interest every single month. Only $350 goes towards the principal, $400 to property taxes, $100 to insurance, and $150 to private mortgage insurance because we put down only 5%. But here's what's really cool. So that $350 a month, it's not much that goes towards principal, but it is a forced savings. We're getting that back, which is $4,200 essentially at the end of the year. But here's something people don't talk about, which is a huge advantage. Your interest is a tax write-off. So that interest payment over 12 months is $22,200 that we get to write off, and the property tax, which is $4,800. So in total, we get $27,000 in tax write-offs to bring down our taxable income. So say we make $70,000 a year. If we didn't own a home, we would give the government $10,200 of our money. But because we own a home and you can deduct this $27,000, we're only taxed on $43,000, which brings the payment down to just $5,000. So we save $5,000 on taxes by owning this home, plus the $4,200 of the forced savings really breaks down to about $786 a month in savings. So this $2,800 payment's really just $2,014. And then once we pay up to 20% off of the total loan, our private mortgage insurance of $150 falls off as well, which will be pretty soon. And we're only going to owe $1,850 a month on this loan, even though we're paying $2,800. So up top, it seems like a lot, but on the back end, you're actually saving. So if you're looking or contemplating of buying a house and the payment is a little high, but as long as you can comfortably afford it, some of these tax advantages kind of makes it worth it.
I did my taxes yesterday as a creator for the first time ever, and I'm going to tell you everything that I learned. Keep in mind that I'm a beauty and lifestyle creator. You have to report all your income. However, anything over $600, that brand should send you a 1099. If you don't receive a form like a 1099, you just submit it as a cash or check. As a business owner, because you are a business owner, you're making money off content. There's many deductions you can use in your favor. Include but are not limited to electronics, office furniture, advertising, supplies, domain and hosting fees, and insurance. You're only using that equipment or furniture or whatever that you bought for your business, you can deduct all of it. However, if you're using it as business and personal use, you have to only deduct a percentage of it. You have to come up with that percentage. In my case, I use a separate bedroom to film. I'm able to deduct that whole square footage of that room in my taxes. If you do the same, it's a simple formula. You just take the square footage of that bedroom or studio or office and divide it by the total square footage of your home. Questions that I was like, can I deduct this? Like, I wasn't sure, was when it came to makeup, skincare, hair products, hair tools, everything that I'm using for my content. The IRS says that anything that is ordinary and necessary for your business, you can deduct. In my case, I wouldn't be able to make my videos if it wasn't for makeup, skincare, hair care, anything. So I'm deducting everything that is related to that. Can I deduct like when I go get my nails done or my hair done, any type of service that I get? Pretty much the tax advisor said, if you think it's necessary for your business, then deduct it. However, if you're just doing it as like a personal day or whatever, you wouldn't have it as a deduction. And I deduct eating out or groceries. Business meals can be a limitation up to 50%. For me, like I don't go on meetings or anything with other clients, so I don't deduct any meals. If I am going out of my way to get stuff for like of content or anything like that, and I pick up a coffee or a meal, I'll deduct half of it. The other question was, how much should I put aside from each brand deal for taxes? And 30% of that brand deal is more than enough. The big one that everyone has been asking about, do I have to pay taxes on gifts? Like, there are two things. So there are gifts that are gifted to you as a form of payment in exchange for a video or a review. There are gifts that are just gifted to you, truly a gift. There's no expectations. You just enjoy the gift, right? We need to declare the full retail price of the product that is gifted to you as a form of payment for a review, a video, anything of that. However, if that gift that is given to you as a form of payment is less than $100, you do not need to declare it in your taxes. How long should I be keeping my receipts? At minimum 3 years. I asked if they could give me any other advice, like, because I'm new to this. She said to make an email for your business expenses only, and every time you buy something for your business, to snap a picture of that receipt and send it to that email. That way at the end of the year, you have that email to reference and you have all your receipts in one place. Again, the other point was to keep the receipts for everything. Bank, credit card statements, they are worth nothing when it comes to the IRS auditing you. They would want to only look at receipts. Lastly, Lastly, when you are claiming expenses, always make sure that you can explain that it is necessary for your business. No way, shape, or form am I an accountant. I do not specialize in taxes. Like, I thank you TurboTax because I love their service. I've been using them for years. Everything I learned and I talked about, I literally typed a whole doc up. I have this linked in my bio. It will be in my link trees. Just scroll to the bottom and it's gonna be there. I'm not sure if you can save it, but it's there for you to look at and read if you have any more questions or you just want to reference back to it.
Here's a list of all the expenses that are tax deductible. The interest on your car note is tax deductible.
Boom.
Your car insurance, car washes. Yes. Car washes details. Keep your car clean.
Got you.
Repairs, maintenance, tires, oil changes, parking, tolls. All these expenses related to your car that you're currently paying from your personal account are now business expenses if you can prove that you're using the car for business.
Got you.
So here are some common mistakes to avoid when preparing for your taxes. Is the number one thing is not having all your paperwork ready. So if you haven't received all your tax forms that you require or don't even know what you need to file, then you're not ready to file. That's the most common mistake that you'll see is a taxpayer will go to an accountant to do their taxes through like a self-preparing mechanism, and they'll do it without everything they need. So I have a lot of clients that don't know exactly what forms to file, where they end up having to amend their return because they'll have to go back and we have to go back and add to their return. So what you want to do is you want to make a list of all the forms you should have, including W-2s, from all the employers you worked for in 2025, 24, and any 1099 forms that you expect, like from gig work, unemployment, IRA, investments. The second one is math errors. So a lot of people think CPAs and EAs are these math geniuses. We're really not. We just study the tax law. So math mistakes are among the most frequent errors the IRS encounters. So that's if you catch the error after you file, you may be able to submit an amended return. But if the IRS determines that you underpaid, however, it will likely demand the additional money. They'll likely demand the additional money plus any interest that generates since the return was due. And then the third mistake is using the wrong filing status. So your filing status is key for the deductible that you can get and how your return is going to be processed. Single, anyone who's currently, not legally married, married filing joint, married filing separate, head of household, qualifying widow or widower. So picking the wrong filing status could be costly. Like, for example, married filing jointly has way more benefits and deductions and also credits than married filing separately. So if you're interested or you feel like you're making one of these common mistakes, I am taking on new clients and I do one-on-one coaching sessions that are monthly coaching sessions. I also help with the formation of your business, basically helping your business grow. And if you're a content creator or you don't make content, hit that follow button, subscribe, and email me. I will leave the email below so we can schedule our one-on-one meeting and come up with the best solution and strategy for your tax situation. My name is Lottie, and you guys have a wonderful day.